be investing, though, in the fixed income market in general? Because obviously they're getting, bonds are getting a little bit of a safe haven flow right now amidst all the jitters. But at the same time, you're saying that there's obviously the risk to the downside for growth, but there's also the risk to the upside from tariff inflation. So how do you hedge those risks in fixed income?
Yeah, so this is where valuations are always critical, right? And the fixed income markets provide a lot of opportunities, not just within the U.S., but globally. So a big thing that we look to do is to diversify exposures rather than having a concentrated bet in just one particular area. An example I'll provide, and something that's changed a lot recently, is the valuations in European credit versus U.S. credit. U.S. credit had an incredible year.
Yeah.
In 2024, European credit was lagging behind. Now you've seen this massive potential for increased stimulus, particularly in Germany, causing upward pressure on European government bond yields. Their spreads are actually tighter year to date, while U.S. credit spreads are wider. So this sort of uncertainty and this volatility is actually very, very, creates a lot of potential for active management in fixed income to take advantage of some of these relative value opportunities across the global credit sphere.
And as a portfolio manager, how are you looking at allocating capital region-wise? So obviously what we're seeing right now is that the U.S. markets are falling, but other markets are not being hit as bad. Yes, they're feeling the ripple effects, but the momentum to the downside is not that severe. So everybody's saying, oh, look at ex-U.S., look at ROW, rest of the world.
Yes, yeah, so we had been buying European credit last year because those valuations were lagging and they were more attractive. Now with the underperformance in the U.S., we are still underweight U.S. credit, but we're starting to reduce that underweight because the valuations are starting to improve. So that is one example. The other situation comes back to this idea of uncertainty. When uncertainty is rising and you don't have that same visibility further out into the future, what becomes really valuable is liquidity. And so we want higher quality carry and liquidity in the portfolios because that creates optionality to take advantage of future volatility.
One of our guests was also making the point that because the U.S. is now in pause mode, it kind of puts emerging market central banks, the Fed is in pause mode, it puts the emerging market central banks a bit in the spot because they don't know whether they should ease in response to slowing growth, given that inflation has bounced back after post-COVID for a lot of these EMs quite quickly. So they need to manage that situation between the balance between inflation and growth. And so how does it look, EM credit to you and fixed income?
EM credit is another area that had a really strong year, particularly EM high yield credit in 2024. So the valuations there are also challenging. But I think you're exactly right. When you look at monetary policy, it's not in a bad position in emerging markets more broadly. Many of these emerging market central banks were actually quicker to raise rates. They were ahead of the curve on inflation. The developed markets were a little bit behind. And so that's left them in a better position to give them a little bit more flexibility. But the other thing, and it comes back to the conversation we were having around currencies, the weaker dollar actually is a little bit of a positive and a support. Oftentimes you see this EM currency weakness that then feeds through to inflation, that then constrains central bank policy and may cause them to have to tighten policy at an inopportune time. The actual weakness of the dollar today can be a bit of a supporting factor for emerging markets here today.